Hey guys, welcome to Joy of the Trade. Today I want to talk to you about a crucial event that's happening this week that I think could have mega impact on all asset classes across the entire world. And obviously everybody this week is focused on earnings because we have a slew of huge tech earnings starting with Tesla, et cetera. And I have some unbelievable videos coming from my colleagues on those. But today I want to talk to you about the FOMC Federal Reserve meeting on Wednesday and why I think it could really shake up the markets. But before I give you my thesis, let's take a step back and look at some of the charts and see what's happened before. All right. So the first thing I want you to look at here is the 10-year yield, okay? And obviously, we had to take rates to zero. The Fed took rates to zero, and the 10-year got down to as low as 50 basis points. And think about it. In 2009, we started the year above 2.5%. So to go all the way down from 2.5%, and then you start around 2%, you get as high as 2% in 2020 and go all the way down, 150 basis point down move. It was pretty aggressive, pretty shocking, and has created a very accommodative borrowing liquid environment for the market. So what's happened is coronavirus has started to subside in the US in terms of lockdowns, et cetera. Maybe not, in people's minds. I don't want to really talk about that today. I don't really care. But what I'm looking at here is we've started to see the economy start to surge back. So you've started to see rates go higher. They've started to go higher. And I'll show you why in a minute. Because what people are anticipating is not that the Fed is going to take rates off zero. They're not going to do that for a couple of years. But what we really have to pay attention to is when the Fed is going to stop buying bonds. And check this chart out here. So this is the Federal Reserve's balance sheet here, which if we go back, let's go back a little bit longer, is almost $8 trillion, okay? So if we compare it to the S&P 500 here, and I'm going to show you why this matters right now. You're going to see it. So this blue line is the S&P 500, okay? Around 2018, the Fed stopped buying bonds. They've been buying bonds. They were buying bonds for almost 10 years, steadily increasing their balance sheet to bolster the economy on the back end of the great financial crisis. And it's their go-to move, basically. They took the genie out of that bottle and they're like, hey, we can buy bonds, we can do whatever. And so we're in this magic money territory because they don't care anymore. So anyways, they stopped buying bonds at the same rate. And it's not that they were selling their bonds. They were just allowing some of the bonds that they had previously bought and all this to run off, which means they expire and they don't get replaced. They turn to cash. They don't get replaced with the Fed buying new bonds. What does that do? Well, that's called tapering. They've been tapering their purchases. And so when we started to taper here in 2018, we saw the S&P 500 go from $2,900 all the way down to 2,900 points, all the way down to 2,500 points by the end of the year, by the end of December 2018. So we had a 15% correction in basically the fourth quarter, which is not fun. And they didn't even do like a mega tapering. They just you see, it was gradual. It went from having a $4.5 trillion balance sheet to $4 trillion. So 500 billion in runoff created this 15%er in the stock market. Fast forward to now, we just went from $4 trillion to $8 trillion. They're just buying. They're buying all kinds of duration bonds. They're buying 3-month bonds, 6 months, 9 months. They're buying long end bonds. They're buying 30 years, et cetera, et cetera. But obviously the first thing when tapering happens to run off with the shorter term paper. And so once we start to see this white line here start to curve, what do you think is going to happen to the S&P 500? Now, Jay Powell has been out there saying, I'm going to keep rates at zero. But he gave an incredibly important clue in his last 60-minute speech that said he expects to start tapering before he's going to raise rates, well before they're going to raise rates at that. And so if we look back at the last couple of weeks, let's just look at the last week anyways, in economic numbers, which is something the Fed looks at. They don't really care if we have inflation because they're going to lie a little bit, but they're looking at it. And the PMI came out last week. Manufacturing PMI came out pretty strong. Anything above 50 is expanding. Above 60 is like, whoo, gangbusters, right? And so market loved it on Friday. Market flew on Friday because manufacturing is coming back. So the Fed might start to think about taking the training wheels off. So this week with the Fed report, pay close attention to the word tapering, to how much they're buying. They're buying about $120 billion worth of bonds right now. Pay attention to how many bonds they're going to expect to be buying towards the end of the year, Q1 2022. These are the signs that are going to be everyone, all the really savvy market participants are going to pay attention to. Because once that happens, if that happens, you're going to see mega selling in stocks. You're going to see interest rates explode to the upside, and you're going to see huge volatility. I don't think it's going to stay that way per se forever, but they never ring a bell when it happens. It's subtle clues that create that tipping point. Anyways, I hope you guys liked this video. If you did and you watched it on YouTube, click like. If you haven't subscribed to Wealth Press, subscribe. We've got tons of videos like this. LFG guys, I'm Jeff Santaneri. I'll be back with more of these videos for you soon.